In this video, we're continuing our strategy blueprint series, where we break down how different trader types can use seasonality in a structured, professional way. Today's focus is commodity traders. Now, commodities behave very differently from equities and FX markets. They're physically driven by actual demand for the particular commodity. They're cyclical. In other words, they're more popular at certain times of the year. Very sensitive to weather, inventory and production levels, and heavily influenced by macro and geopolitical events. There's just certain times of the business cycle when certain commodities are in more or less demand. And because of that, seasonality in commodities is not optional, it's foundational. So, first of all, let's define the commodity trader. A commodity trader typically trades metals, energy, or agricultural markets. A commodity trader will be very aware of supply and demand fundamentals for the underlying product. They will be aware that they have to face sharp volatility spikes, and they must respect inventory and positioning data. So the challenge with commodity trading isn't just the direction, it's understanding when structural flows are likely to dominate price. And that's where seasonality becomes extremely powerful. So the first and most important layer is annual seasonality. Now, unlike many other markets, commodities often have very clear annual cycles tied to weather patterns, planting and harvesting schedules, energy demand cycles, holiday periods, industrial production cycles, jewelry, and physical demand. Now, this creates recurring tendencies in markets like gold, silver, platinum, crude oil, and natural gas, and corn, wheat, soybeans. So let's just take a look here at gold. Right? You can see with gold that one of its strongest patterns seasonally is from the end of December, typically just after the last Federal Reserve meeting, when investors have kind of certainty or some sense of direction of the Federal Reserve interest rate decision heading into year end, and the middle towards the end of February. Look at gold here. Over the last 25 years, gold has had an 83.33% winning trade percentage, an average return 5.20%. It's a very strong seasonal pattern. It's very reliable, delivers year after year after year. Similar to gold, we also have silver. It follows gold in many ways, and you can see that this end of year pattern also occurs in silver. There's often physical jewelry demand for Christmas holidays in the West, as well as physical demand for the Chinese Lunar New Year, particularly with gold being given as a traditional gift. And when you compare silver and gold together, if we just use Seasonax's comparison feature here, you can see that when you compare gold and silver together, that they behave very similarly throughout the year. Also, if you look at platinum, industrial demand for platinum means it has an extremely strong seasonal pattern. Over the last 25 years, platinum has gained 87.50% of the time from 20th of December through to the 18th of February. And just look at that gains that we've seen. Average return 8.91% over this period during the date range selected, and the maximum profit has been a stunning 39%. Really strong production demand here, and purchase managers tend to put in their purchases for platinum for the industrial year at the start of January, and that seasonal pattern very, very reliable. Crude oil has a very interesting October-November shoulder season where it's too warm for peak heating demand and it's too late for peak transport demand. So you get this natural slump in crude oil that tends to come around this period from the beginning of October into the middle of December. You can see here over the last 17 years, the oil has fallen over 55% of the time, nearly 60% of the time, and an average return of negative 5.88%. So it tends to be a very weak time of year for oil. Natural gas as well. By October, US natural gas storage is typically near its seasonal highs, and the heating demand hasn't really picked up. And as you head into the end of the year, you can see that natural gas has some pretty significant falls over the last 17 years. You can see natural gas has fallen over 80% of the time, and an average drop of 13.07%. So corn, again, another weather premium risk. In spring, for corn, you tend to see markets price in market planting risk, which tends to support prices. But by midsummer, crop conditions are often clear. And if weather is stable, right, risk premiums decline, and this often creates a downside pressure in corn. You can see here over the last 17 years, corn has experienced some significant downside, average falls of 8.12%. So as you can see, for commodity traders, annual seasonality really can set directional bias at certain times of the year, helps frames risk appetite, and you can use it to avoid fading structurally strong periods or the other way around. It can keep you out of a market when you're heading into a really seasonal bias. Remember, it's not about predicting, it's about aligning with recurring supply demand cycles. And there comes times when you have the macro conditions and the seasonals all lining up together, and that can give you some great opportunities. Now, the second layer to look at is intra-month seasonality. Now, intra-month seasonality can be often overlooked, but it does matter. And commodities can exhibit recurring patterns within the month due to contract rollover periods, options expiries, inventory reporting schedules, fund positioning adjustments around the turn of the month, physical settlement cycles. So you can see here gold, intra-month, start of the month, you tend to see upside in gold with a bias towards upside the first few days of the month. Also notice with energy markets around inventory report timing. Again, on the day of the report, you tend to see a slight bias for upside in oil. And if you look at the day of the report and the 2 days afterwards, you can see that there is this slight bias of upside that the oil markets tend to note. Also, agricultural markets may behave differently around USDA report windows. And for traders, this just helps refine entry timings. You can avoid low liquidity periods, and you can anticipate volatility clustering, where you're going to get, a series of events that are likely to result in significant volatility. A third layer is event seasonality, which again is particularly important in commodities. Commodities do respond very strongly to recurring events such as central bank decisions, inflation data. We've already looked at oil inventory reports, again, OPEC meetings, government supply reports, weather-related forecasts. So using event seasonality allows you to study these post-event moves, right? You can see maximum, minimum historical reactions, whether spikes tend to extend or reverse, and how long momentum usually lasts. So for instance, let's look at gold here on the Fed meeting. You can see on the day of the Federal Reserve meeting, gold has a bias of upside with some outsized gains. I mean, look at this 2026 move, 4-5% on the day of the Federal Reserve meeting. Incredible move, and a median return of 0.18%, average return 0.20%. And just very helpful, so you can see the level of volatility on a Federal Reserve meeting. And you can see just by doing a quick eyeball here that the average maximum moves tend to be upside 1.5%, some outsized move to 2%, but there's also some moves to the downside of 2%. So very helpful for volatility. If you look at inflation data as well, let's look at the CPI. Again, gold very responsive to inflation data points. And you can see here that on the day of a US CPI print, there's an average return of 0.25%, 63.33% winning trade percentage. And again, this bias for upside, maximum upside 3.47% on a US CPI print, maximum loss 2.91%. You also have the very helpful data in the maximum rise and the maximum drop. So you can have a sense of where the extremes of the move are. And you can see here, 3.47% was an extreme of the move to the upside. And again, to the downside, you can look through the data to find those extreme volatile moves. So obviously you can see here that this really helps with stop loss calibration for commodity traders over events. But, you can just look at the seasonality, generally speaking, to get a sense of the volatility that you're going to see, right? So, during this seasonal period for soybeans, you can see the maximum rise and the maximum drop. And that just gives you a sense of what extremes you can expect. Commodity markets can gap unexpectedly. They can also reverse sharply. They can trend persistently as well. And seasonality just helps with that volatility calibration by analyzing, historical drawdowns, typical adverse excursions, what are the seasonal volatility shifts that you might see, and that can help you decide whether your stops need to be wider during certain months, whether tighter stops are perhaps justified in quieter periods when maybe a market is not moving as much as you would expect, and you can see the general, idea you can think was, is this the right time of the year for this idea to have tailwinds, right? And if you get a number of factors aligning, you're not forcing the trade. You could be trading with cyclical momentum. So the key takeaway for commodity traders is this: seasonality in commodities is not a niche add-on. It's just part of the structural DNA of these markets, right? And by incorporating annual cycles, intra-month tendencies, event-based behavior, and volatility-aware stop placement, you move from relative trading to probability-based execution, right? So if you trade commodities, you can explore these patterns inside SeasonX and just test them against your existing strategies. Because in commodities, edge often comes from understanding the cycles, right? Not just the charts.